Hello, this is Dan Beniak, a Municipal Portfolio Manager here at Treasury Partners. We're back with another brief update on what we're seeing in the municipal bond market. To cut a long story short, we're really steady as she goes in terms of our outlook. For some time now, we've been seeing greater value in long-term municipal bonds than we have not only compared to short-term municipal bonds, but also over fixed income markets, including corporate bonds and treasuries. The reason for that is simple. The municipal bond curve has been fairly steep for some time now. When we say a yield curve is steep, we mean that shorter term yields offer a lesser income return compared to what investors would get for going out longer on the curve with longer term maturities. This isn't an unusual situation in fixed income markets. Logically, most of the time, you should be getting paid more to lock up your capital for longer. But what we point out is that the municipal bond curve is relatively steep. You usually don't see this much of a difference between short-term and long-term maturities persist for as long as it has at this point. So as you can see, shorter-term municipal bonds on an absolute basis, you're getting anywhere between 2.25% to 2.5% once you build in the credit spread. Whereas in longer-term municipal bonds with a final maturity of anywhere from 20 to 30 years, but with a 10-year par call, you're getting these days 4.25% plus. Again, and that's with perfectly good structure, no adventures in terms of credit, very strong fundamentals, and a nice liquid market. We're locking that in client portfolios because we can see that, on a relative basis on the long end, we're able to lock in a return that's approximately, equal to what you can get in treasuries. But again, remember that municipal bonds are tax exempt at the federal level, and depending on your state of residence and the state of the muni bond, state and local income taxes as well. So depending on your tax bracket, that 4.25% is the equivalent of earning anywhere from a 6 to 8% fully taxable return in other markets. That's what we target when we're allocating to riskier asset classes, such as equities or alternatives, except you're able to lock that in with a strong, fundamentally safe municipal bond portfolio and lock it in for the long term, anywhere from 7 to 10 years in a series of rolling call dates. We think that's a tremendous opportunity for clients. We're still targeting that because we think it's a great deal out there for most people in most situations, adds a lot of ballast to portfolios. And unless and until that changes, that's where we're going to keep allocating the bulk of capital within investor bond portfolios when they're subject to a tax liability. If you have any questions about how this outlook affects your specific portfolio, please give your advisor a call. We'd be happy to chat, and we'll see you next time.